Housing is expensive and getting a mortgage is actually harder than you think. If you want to increase your chances of getting a mortgage and being approved by lenders, you need to follow these simple instructions. Now, one of the first things that decides whether you can get a mortgage or not is your borrowing rate. Banks lend on risk. The more money that you borrow, the more cautious banks are. If you want to find out how much you can borrow, I'll link in the description a website that you can check. Now, if you're a single applicant earning roughly £30,000 a year, you'll be able to borrow anywhere between £125,000 and £135,000. If you're a single applicant earning £40,000, it could be anywhere between £160,000 and £180,000. However, if you have a couple, aka two applicants earning £35,000 each, they can borrow between £315,000 and £330,000. Another way to ensure that your application is approved is to borrow under the recommended maximum allowance. For example, if you will be granted a £300,000 mortgage, you should aim to be around £270,000. This sits you comfortably under the maximum amount. Now, one of the biggest impacts on whether you're approved for a mortgage is the 6 to 12 months lead up before applying. Banks calculate your affordability based on your monthly commitments. Now, lower outgoings means that you've got lower risk. Let's say, for example, that you have a car on finance and it costs you £300 a month. This can reduce your potential borrowing rate by up to £30,000. Even £200 in other commitments, such as Amazon Prime or a subscription service or a gym membership. All of these subscriptions add up and they can actually reduce your borrowing potential by tens of thousands of pounds. Now, in the lead up to your mortgage application, ideally 12 months before, you want to try and reduce all of your outgoings by as much as possible. It's no secret that lenders actually want predictable incomes, but there are ways that you can do to increase your income or how it looks on paper. When applying for a mortgage, a bank will want to see a regular income. Normally, what they prefer is an individual that is employed by PAYE. This is because being self-employed or through a limited company, your income can vary from month to month. These accounts are essentially seen as riskier. Some months you might make a lot of money, but other months you might make less. Normally, individuals that are PAYE only have to wait 6 months before they can apply for a mortgage. This is because that is enough financial information for a bank to make a necessary decision on whether they want to lend to that person. However, if you're self-employed, unfortunately, you're going to have to wait for 2 years worth of accounts before you can apply for a mortgage. This is because the banks want to see a steady, regular income over a 2-year period before they even look at potential applications. For PAYE individuals, focus on your base salary. If you can get a pay rise that is on paper in black and white, that is much better than a discretionary bonus every single year. If you're looking to apply for a mortgage on a self-employed basis, in the 24 months leading up to that mortgage application, you need to make sure that you have as much money coming in and you're taking out as possible. If you're claiming all expenses and reducing your tax obligation to as limited as possible, this isn't going to show well when you're looking to get a mortgage. Now, in both cases, you need to keep a stable job. So again, for self-employed, it's 2 years. For employed, it's a minimum of 6 months. You need to prepare for the stress test. And this isn't a physical test. This is what banks will do when they are assessing your mortgage application. Banks and lenders don't actually care about today's rate. They care about what the next 10, 20, or 30 years of your mortgage term looks like. One of the things that banks do is they will stress test the percentage that you can pay back. Even if current rates are low and you are offered a mortgage at 4%, banks will test whether you can repay at 7 to 8%. This is because they want to make sure that if rates do rise, that you have the ability to pay back what you owe. Banks stress test now because they don't want a repeat of the 2008 financial crisis, where essentially everyone defaulted on their payments all at once and it caused a global collapse. At the moment in 2026, mortgage rates are going down, and that's a great sign for borrowers. We have 2-year fixed mortgage rates under 4% for the first time in a long time. However, this isn't a justification for the future, and it's not to say that they're going to stay there. This is why it is extremely important to budget across multiple different scenarios. Do the stress test yourself. Stress test at 8%, stress test at 10% if you really need to. Now, the biggest thing that you can do to increase your affordability rate when applying for a mortgage is to have a large deposit. Banks like low-risk products that they can sell on. The more money that you put as a deposit means that the less risk the bank actually has to take on because they're giving you less money to purchase that house. This is what's known as loan to value ratio. Now, not only does a larger deposit give you the potential affordability to buy the house that you want, it also gives you access to better rates. Because your loan to value is smaller and you're putting in more money up front, you actually might qualify for lower interest every single year. For example, a £300,000 home with a 5% deposit or £15,000 will mean higher rates, tighter stress tests, because your loan to value is at 95%. This is a very high mortgage. However, a 15% deposit, or £45,000, will give you access to lower rates and a higher chance of approval because banks only have to lend you the remaining 85%. If you're looking for a mortgage and you have the ability to, try and aim for a deposit between 10 and 20%. This will significantly increase your chances of approval and it will give you access to cheaper rates. Now, it's not all about how much money you earn per year and how big your deposit is. It's also actually about your credit report history. Most people confuse this with their credit score. Credit score and credit report history are totally different. Banks actually don't care about your credit rating. They couldn't care if you are perfect and have 1,200 out of 1,200. What they care about is how reliable you are with paying back debt. For example, if you've missed payments on your phone contract, that is a huge red flag to say that you didn't have the money at the time to pay back that obligation. One of the main things that catches people out with their credit report is that they borrow too much. This is what's known as credit utilization. A higher credit utilization is a higher perceived risk in the eyes of a lender. Let's say, for example, that you have a credit limit of £10,000 and you borrow £9,000. This means your credit utilization is 90%. What you want to try and do is keep your credit utilization below 30%. Having a high credit utilization means that you are dependent on that credit in the eyes of a lender. Now, just as important as your credit utilization score is your credit report history. Specifically, anything in the last 6 months, lenders will look at with scrutiny. A few points are: keep credit utilization under 30%. Pay all of your bills on time, and avoid opening new credit cards in the 6 months lead up to a mortgage application. Now, a few smaller things that you can do to increase your credit report history are register to vote. The second thing is also make sure that if you have messy old accounts, close them and then wait 6 months before applying for a mortgage application. There are small actions that you take every single day that will kill your chances of getting approved. One way I would categorize this is anything that adds monthly payments. If you're thinking about opening a new credit card in the 12 to 6 months before your application, don't do it. Now, another one that does catch people out, not very often, but it's worth a consideration, is staying in the same job during your application process. If you start a mortgage application and you are about to change jobs, it's probably worth waiting to push off the mortgage application until after. However, if you're self-employed and you're going to go into an employed rate, this can actually speed up your process because instead of waiting for 2 years, you only have to wait for 6 months. Now, one of the biggest mistakes that people make when buying a mortgage isn't actually at the start. This is what I call having an exit plan. Now, as we've covered over this video, lenders like borrowers that aren't overexposed. Likewise, you need to think like a bank in this situation. You need to ask yourself the following questions. Could I sell quickly if I needed to? Is demand in this area strong? And could it be rented out if my plans change? Now, all of these factors are influenced by travel links, by the employment opportunities, by local schools, by the local surrounding area. We don't want to think about selling our house, or if in the event that we need to change, have we got the ability to? A big word of caution is when buying a home, think about the future. Now, on average, homeowners move every 10 to 15 years in the UK. And although we don't want to think about it because it's exciting, we're buying a new home, we need to think about, well, what happens when I need to sell this property? Don't get caught up in the emotion of buying a property where you put everything else aside because you have to have that home. Mortgage approval isn't luck. It's about preparing and making sure that everything is in order before you start. Start by stress testing your mortgage application. Reduce your outgoings as much as possible and build a really strong deposit. Clean up your credit and plan your exit in 10 years' time. If you do all of these, you're not going to just get approved. You're going to buy a home that actually works for you now and in the long term. Applying for a mortgage isn't difficult, but you need to bring in rationale. You need to understand what banks are looking for, how they lend, and what you can do to impact your approval rating. Hopefully you found this video helpful and that it will help you with your mortgage applications in the future. Click the like button if you found it interesting or it's helped you in some way or you learned something. My name is David, and again, thanks for watching.